Do you check?
How do we stop duct taping tools together? We retool. How do we stop duct taping tools together? We retool. How do we stop duct taping tools together? We retool. How do we stop duct taping tools together? We retool. How do we stop duct taping tools together? We retool. How do we stop duct taping tools together? We retool.
Alright, guys. Good. Give me a heads up on X. Let me know if you guys can hear me.
How do we stop duct taping tools together? We retool.
Alright, guys. Good. Give me a heads up on X. Let me know if you guys can hear me.
How do we stop duct taping tools together? We retool.
Alright, guys. Good. Give me a heads up on X. Let me know if you guys can hear me.
How do we stop duct taping tools together? We retool.
Alright, guys. Good. Give me a heads up on X. Let me know if you guys can hear me.
How do we stop duct taping tools together? We retool.
Alright, guys. Good. Give me a heads up on X. Let me know if you guys can hear me. ad or something that keeps playing in my headphones. I'm not sure if you're hearing it constantly, but good grief, man. I don't know what's happening. It just keeps looping and looping. But anyway, good morning. Hope you're all doing well. So I'm trying to get a feel for. Okay, I can hear myself talking now. All right. So anyway, good morning. So this morning we have economic news out here in about 8 minutes or so, and I have the daily chart here, the larger chart to the left. That's the daily NASDAQ here. And let's change that to MNQH2026. Alrighty. So that's the business here. And secret sauce off there. What was that? So here's the daily chart on micro NQ. And if you notice that we have went up in here, took out that high. Now I stated that, I'm bearish. I want to see lower prices. And we were down in here. I said it could come up, fill in this little inefficiency here, which it did. Spent a lot of time in there. Then we had this candlestick right here. I taught lecture on stating that the body was not able to go below the previous day's body, and this body was not able to go above previous day's body. So this is an inside day, despite the fact that it went higher on the wick. Okay. So long story short, I said that this might happen. It might bump up in there, and it may challenge my stance. Go back and listen to the presentation. You'll hear me talk about it. It was concern for me. I'll have to weigh out whether or not I'm right or wrong in regards to that. So it did go up there and hit it, and then immediately gave up the ghost, and now here's where we're at. So I view that as, well, let me preface it by saying there's a disclaimer in the description box of the live stream, below the live stream. You should read that. Okay. Everything I'm talking about here is just for informational purposes only. It's not meant for you to take a trade. Okay. You're not going to be getting signals from me. You're not doing any of that here. We're reading price action, looking for things that repeat a phenomenon that is useful to you for your own analysis and, tape reading, demo trading. We don't do anything in regards to try to instill a desire for you to trade with real money around here, because I'm not licensed to do that. You shouldn't take advice from anybody in the world doing that either way. So I'm at the top of that list. But it went up here and bumped that high. You can see it hit it here. And that now has been taken. We revisited that volume imbalance and took the liquidity. And now look at this. Does this bode well for bullishness? I would argue against it. Now we have PPI this morning. So in a couple minutes, about 5 minutes from now, there's going to be a lot of volatility that's going to come into the marketplace. And I think that it may want to seek the sell side below that short-term low right here. Okay. Um, let's play retail trader logic. Okay. This is a rarity. You see me do very little of this, but this is a trend line idea that folks that use it, and they like to do these things. They'll look for all these potential supposed touch points and say, okay, here's what I think is going to happen. It's going to use that level to provide some measure of prognostication. And I look for these types of things to suggest that maybe they're wrong. And if that's the case, this liquidity rating here below that low, I think is much more useful in terms of what to expect, because we've already came up here rather aggressively, hit it, and then it said, no, I'm not interested in staying up there. And then it respected the volume imbalance again here, opened and went straight down. We have a volume imbalance here. So worst case scenario, let's say that at PPI, the market does a wild spike, does some crazy business, and it could revisit this and then go lower. or just go straight lower. Either way, my primary interest is lower. We have a larger sell side liquidity pool here. And as you recall, I mentioned these lows over here. I had like hello written on them in my first mention of it. So with that idea in mind, let's hurry up and quickly drop a. Please do not take trades based on what I'm saying. Okay. I'm generally wrong on PPI and CPI. I have a very, very low strike rate when it comes to those reports. That's why I don't trade ahead of them. That's why I don't position myself ahead of them because I have been burned. I've lots of money trading, and I can't do that in front of all you and in good conscience say, trust this logic, therefore put positions on. Okay, so I'm warning you, I'm usually wrong with PPI and CPI. Now, what this does is gives us a rule of sitting on our hands, waiting for the carnage to come in. And then whatever the liquidity is left in the wake of that price run, that's what we focus on. Okay. It's you'll see what I mean in a second. Well, maybe not in a second, a couple minutes, 2.5 minutes or so. So we have this logic here. I'm going to keep it red just simply because I'm if it does reach up into that, I want to kind of like maintain the idea that I think it may want to reach lower. And then we'll also use this. If you lose money today trading this, I don't want to hear about it because you didn't listen. If you made money, I'm going to block you if you tell me anything about it. Okay. There's too many people not listening. I asked you very kindly not to tell me you're using my commentary to trade on. That's the worst thing you can do, and it makes me not want to do it at all. I understand it works really, really good, but hey, eventually I'm going to do it wrong, and you're going to find fault in me and not remember I told you don't trade with real money using whatever I say. Then we have yesterday's low, which I guess we can highlight that as well, just for completeness sake. And then we'll drop down to 1 minute chart. It's already drifting lower. So usually that's kind of like a trap. He'll run it and rip people's faces off. And then later on go, where it really wants to go. So it can act a little bit like a FOMC. They'll usually sometimes see a big run, and then whatever the low or high forms, the liquidity before the move that happens at 8:30 at PPI and CPI. The idea is then to try to target that liquidity, even if it's several hundred handles. Eventually, it finds its way back there. May not do it today because it's a Friday. All right, just 15 seconds, and then all kinds of stuff's going to happen. Do not be in the market right now. Just sit still and watch. So we took out yesterday's low. That's this here. Oh, bones. So after this settles down, we'll watch what it does for about 15 minutes. And then I'll go into a little bit of a lecture for you. And then we'll break away before um, an hour recording time is done because I don't think I was able to be successful in getting off of the live stream in time last time. I think I went over by 2 minutes. And I think that's the reason why it doesn't create the automatic AI translations so that way you guys can watch it in your language. I toggle and include every single language that's available. Some of them simply just don't work. They say it fails. I don't have anything to do with that. Like I don't do any kind of settings except for allow it to be done by YouTube servers. So don't be mad at me. I'm doing what you guys asked for, but it takes time for them to do the translations as well. Watching the wick here and seeing if we keep a close below midpoint, because if it does, that usually warrants a lower low. Kind of a lackluster PPI number. Well, not the data. I don't even look at the data. I could care less about the data, especially now. I mean, who's going to trust the information that's coming out of this administration right now? The information is it's it's trash. Okay, you're getting it late many times, and I don't trust any of the data. So we're in clown world right now. So you're going to have to follow the logic that only price action gives you. Fundamentals, you'll be fundamentally insane if you try to trust all that data right now. It's fundamentally a gamble. So on a 5-second chart, we had the SIBI here, trade up into it, sold off, SIBI here with a volume imbalance, sold off, put a close below, consequent encouragement here. See if I can. Here's the midpoint or consequent encouragement. Closed below it, came up, hit that. So we want to see if it still has the ability to find its way lower. And whenever there's a target, like I just outlined on the higher time frame chart, like I gave you the daily previous day's low, highlighted that. Then I gave you old lows and highlighted each one of them respectively. I think there's a couple more below there. Yeah. Whenever there's a hard objective like that, when it's so obvious that it's an old high or an old low, when static price points like that for the purpose of liquidity is in play, what I like to do is I'll take the fib and I'll lay it over top of them. And I'm just ballparking it. It can be off a couple points. And it's because I'm trying to just eyeball it with this. The the idea is I want to watch how much energy does it spend to get down to the levels. You can see right away we've already traded down to the upper quadrant that would be viewed from yesterday's low to the next pool of liquidity I outlined here on the daily chart. If you don't know what that is, you can rewind. I think I have DVR settings still permitted while watching the live stream. But the problem is when you do that, you may try to go back to listen to me live, and I may say something that you miss. So just go back and watch the recording later. But you can see we traded right down to the upper quadrant of the range between yesterday's low and the next pool of liquidity I outlined. See that? So what would be in a perfect condition, a perfect scenario would be to see price try to gravitate down to the halfway point. And once it breaks below that, generally, it's likely that you'll see a sustained price run. You can have retracements, but usually it means it's likely to continue lower. That's event horizon, by the way. So this is event horizon. So we have an old daily low here and an old daily low here. So they're static price points. They're not hiding it from you. So by having those reference points, it's in areas where you wouldn't be expected to see that. Wyckoff doesn't talk about that stuff. Elliott Wave doesn't talk about that stuff. It's very it's very succinct. It's very specific. It's not ambiguous. It's knowing very specific finite locations and price, old highs and old lows. Okay. And then because they're old PD arrays, we want to see it try to gravitate down to the midpoint. And midpoint would be, in this case, the consequent encroachment. Its title would be event horizon. So it's the midpoint between two key PD arrays. It could be seen through the lens of a new week opening gap, a new day opening gap. I originally taught it through the premise of looking at one new week opening gap to another new week opening gap, and then measuring the extremes from wherever price is now. If you have a new week opening gap above you and a new week opening gap below you, measure those two and get a halfway point, and price will likely draw to that halfway point. That's event horizon. So anyway, I tossed that in there with no extra charge, but that's when I'm looking at price levels, even though over the years me teaching, you don't see me doing these measurements and stuff. What I'm doing, and because I have like over here, I have charts over here and over here. When I was talking to you, I had my whole ensemble in front of me. So I had 12 screens, but I'm talking to you right here on my dining room table on my laptop. Simply because if I go upstairs when my wife is not here, puppies want to go upstairs and they stay outside the door, and I don't want them scratching my paint off the door. So that's why I've been hanging out down here. Since I had the girls, I moved away from being up there. So I barely ever go up in that room. But hopefully, as we get closer to the spring months and I do more active live streaming, I'll want to do that because that way I can comment on a time frame, not necessarily have to toggle the change in the view of the chart while you're looking at my live stream. I will prompt you to look at your chart. So that way I keep my focus on the one time frame. Like for instance, we're looking at a 1 minute chart here. That 1 minute chart is kind of like where I want to keep my commentary on. But if I have the 5 and 15 second chart respectively over here on the right hand side, that's enough. Like that's plenty to find, ongoing commentary to justify whether or not a move should or shouldn't continue or a PD array should be noteworthy. So about 6 more minutes, and then I'll give you something to go home with into the weekend with how to backtest and also how to look for live tape reading conditions using these smaller sub 1 minute setups. So how about that? My boy Cameron, he's got 51%. No net loss losing days. In the last 2 weeks, he's been running pretty consistent. Yesterday, I worked with him a lot. I talked to him and showed him lots of things in regards to overcoming fear. And because it's a unorthodox way of teaching it, um, none of my students would ever endure it. You would be afraid of it. You'd be scared, and you wouldn't have anything except for trauma on the other side of it. Okay, so just know that I teach extreme drawdown mitigation, and once you do that, once you see it in your hands, it's like you don't fear taking a loss. Like you don't have to fear anything like that. You once you absorb a measure of drawdown that is controlled. It's legitimately controlled. It's you think it's going to go up, so therefore trade the other direction and go down. And I'm not saying do this with your live account. I'm not saying that. Okay, I'm saying to do that with a demo account and then practice on trying to mitigate that drawdown. That's a wonderful, wonderful project to work on because what you're going to do is teach yourself subconsciously seeing a negative number, what your balance was and what it is right now. And if you draw it down intentionally and then work towards building it back up, you're actually doing what 99.9999999% of every educator, every trader trains themselves or teaches their students to do, which is overcome fear of losing. What's more beneficial? Teaching people high probability conditions and setups, teaching them good risk management on those setups, but never touching on the topic of going into the drawdown, controlling the drawdown, and then having the protocols and mindset to overcome them and come out of it. Because everybody goes in the drawdown. Like it happens. It's going to happen. You're going to have a drawdown intraday. You're going to have a drawdown intra week. You're going to have several weeks of drawdown sometimes. It's just, it's likely to happen. Okay. And if you're brand new, it's really going to happen a lot. It's going to come in when you least expect it. And if you're brand new, it completely wrecks your confidence. So, one of the things I teach with my kids is I will literally sit with them and I'll have an account in my name and I'll tell them, you tell me buy or sell, but you have to continuously tell me when to get in, when to get out. I'm going to click the button. I'm assuming all of the risk. I'm taking all of the monetary risk. They're doing one contract and I'm listening to them. When they say buy it, I'm buying it. When they say sell it, I'm selling it. And regardless of what they think is going to happen, the outcome, because I know that they are in the beginning, they didn't know what they were doing. The market shows losses. They see it. That's dad's money. They see it. So now they care more about it if, than it was their own money. Just think about that. The weight of that now has a lot more emphasis. There's more significance behind it. So now they care about it. So whereas if I just gave them money, okay, if I gave them money and say, here's some money, go do whatever you want to do with it. They'll blow it, they'll spend it, they'll do whatever they want to do. Or if they were to take it and put it in a trading account and lose it, they would take greater risks with it that way because it's in their eyes their money. Dad gave it to me, and therefore I can do whatever I want to do with it. But if they are doing it with my money, now the weight of shame, the weight of dad's going to be disappointed in me, that emphasis needs to be held with your own account, with your own money. But isn't it weird? That's how we are when we trade. It's like, well, it's my money. I'll do whatever I want to do with it. And I'll have extreme patience while I'm in a losing trade, but I'll have very little patience when the trade's a winner. You see that too? So there has to be a paradigm shift that has to take place. Otherwise, you're going to be met with a great deal of adversity and hardship while finding your own consistent model. So what I do is I'll put money into an account and I'll say, look, you tell me when to buy and sell. And we have to do this for the next hour continuously. So I'm always in a trade. So when I get out of the trade, when they say, okay, close it, I'm asking them immediately, now do what? Am I going to buy it again or am I going to sell it again? And this is real money. Like it's real money. It's not a demo account. I'm letting them see it. And they've watched 60, 70, $80,000 walk out of my account based on assumptions, things that they had impulses about. Just you tell me what you think's going to happen. Now, there ain't nobody out there doing that. There's nobody else out there doing that at all. Because number one, they're fearful. They think that's the only amount of money they're ever going to have. Just like when you put an account together, you think that's all the money in the world. It's never going to be another penny beyond that. So therefore, you're scared. And scared money doesn't make money. So by having them listen to the feedback of what real money losing and profiting makes, it's interesting how they get panicked. And they're like, Dad, are you okay? I'm fine. I'm fine. None of this bothers me. But you're getting an insight that no one else is going to teach you. You can't learn it from anybody else. There's no paid mentorships that do this. No paid mentorship would be willing to put their students through something like that. But you're going to get a real world crash course on, wow, this is what it feels like. Yeah, this is exactly what it feels like. But now the weight of the matter is multiplied greatly because it's your dad's money and your dad's sitting right there and he's listening to what you're saying you should do, buy or sell, buy or sell, buy or sell. Dad's owning all of the responsibility. Dad's pushing the button, but it's your decisions that direct and dictate the outcome. And what I'm doing is I'm forcing tilt conditions. You know what it feels like when you get out there and you get into a trade. It really wasn't a good setup. It really wasn't. But you're bored. So therefore, you do what? You act on your boredom and you press the button and you get in and you want to find out what it's going to do afterwards. That's not following a model. That's curiosity. That's all that is. And curiosity has blown more accounts historically than anything else. You want to see what will happen if you get in right now because you don't have anything to get on as a model. There's nothing indicating that you should be entering the trade at all, either direction. But because you sat there longer than your comfort allowed for, you go in, you push the button. And maybe sometimes you get into it where you're like, okay, I'm going to get in there, and if it starts moving, I'll ride it out. But if it doesn't move against me, or if it does move against me, then I'm going to reverse. I'll go the other way. Tell me I'm not telling you the truth right now. If you're following me right now, watching it live, put a number one in uh, X and send it to me. If you're going to be honest now, you've done this where you're just curious, you just don't know what you're doing, and you're bored, and you just want to put on a trade because you just want to do it, and your mind subconsciously is saying, before you get in it, if it starts moving against me, I'm going to go the other way immediately. I'll reverse it because it's probably going to tell me I'm wrong there, and it'll probably go the other way, and I'll make money that way. If you've ever done that, if ever thought that, put a number one and send it to me. If you're honest. Let's see how many people are honest. But when I was younger, I did the same stuff. Like I didn't have a model when I first started. I was just guessing. I had no idea what I was doing. But I was expecting money to fall in my hands once in a while. And as long as I made money over time, that's all that mattered. And I didn't care about knowing what it was I was looking for. So, real quick. So we traded below the upper quadrant between the two liquidity pools, and we made three lower lows. You see that on the 1 minute chart here? We have a low, a lower low, a lower low. We have this inefficiency right there on the 1 minute chart, right there. And that looks a little smooth up here. So let's just annotate that, and then I'll get into the business of talking about um, sub 1 minute setups. Okay, and then that high. Yeah. So just had them there as for reference. I'm not suggesting that you should expect them to trade up there. I just want to see if it does that. If it does there, how do we trade that? If we trade to it and repel away from it, if we don't go up there, that's insight too. But if it goes up there and goes through it, that might create an inversion that may seek that liquidity right there. So we'll see. But I'm not bullish. It would just be something I'm watching. But the idea is that I've sat there, all of my kids now have experienced this. They all have seen what real money going in and out of account looks like when there's a large balance, not like a couple $1,000s, or $5,000 account or $10,000 account. You know, they've seen $100,000 account being directed by their own commands of whether being buyers or sellers. I'm clicking the button. I'm clicking the button. I'm clicking the button. And then what I do is I show them how to mitigate that and resolve all of that and erase it like it wasn't even there. And it's admittedly as dad, dad and ICT, it is fun looking at them and watching their face go white, pale, like all the blood drains from their face. They're like, oh no, because in their mind, even though they were raised, kind of affluent, they they know that's a lot of money. Watching 50,000, 60,000, $70,000 just get erased in a very short period of time, and then watching that get rebuilt using logic that you're not getting that from educators. Like nobody's teaching loss mitigation. They don't do that because to do that implies that you're going to lose money. If you're going to lose money trading, they're not going to want to buy my course. They're not going to want to sign up to my signal service. They're not going to want to be a part of my community because everybody that sells education or a course or a membership of some kind of community, if you're paying them, they're going to fancy dance and tiptoe around the subject of you're going to lose money doing whatever they're teaching. You're going to lose money doing what I teach. But here's the difference, okay? The difference is I teach you how to get it back. I teach you how to control the drawdown. Now, a lot of you don't want to listen to that. You think that I'm going to teach you every day, every winning, every trade's a winner, no drawdown, the stop loss that never gets hit. That's what you think. But the reality is you're going to have to find your way amongst all of that. You got to navigate this stuff, and it's not easy. It's very hard. It's very, very hard because all of you, just like I had my own personality characteristics and traits that they're flaws, they're character flaws. We all bring them into trading, but you have to take it back to basics. It's math, folks. That's all this is. It's math. And for folks that didn't study math or excel in math, it highlights your shortcomings because you think that the last loss or the last losing day or the last losing week, net loss week, that's defining your outcome because you lost those trades. Therefore, you can never find winning setups and you're always going to be feeling depression, fear, anxiety, trepidation. You're going to be paralyzed and you won't be able to think soberly. You won't be able to navigate without the emotional tug of wars of what you just did to yourself. And what I have tried to do is cultivate this with my kids where they shouldn't fear money being taken from them. Money is like your breath. Do you want to hold that breath in that you just took in forever? No, it's painful to do so and you'll die. You have to breathe it out, exhale it. Okay. And money in a trading account has to be viewed the same way. It goes in and out and goes in and out. And it's normal for that function to occur. The problem is you don't want to hold your breath on an exhale or an inhalation too long. And it's crazy how everybody sees a trade that may be indicating that it's not likely to pan out. You'll hold that trade until you either get a margin call or the pain is so bad because you didn't want to use a stop loss, or you'll take a full stop if you've used a stop loss, and then you weather a greater degree of drawdown than you should have. But when you get into a winning trade, because you've not back tested, you've not studied how these things pan out, you've not seen how the duration of the sessions dictate the pace and magnitude of how far these market moves are going to go in deference to the daily range and what the daily range is likely to do on that daily chart. Having all these things in the forefront of your mind helps you. This is why I have a notepad next to me all the time when I'm looking at charts, whether I'm taking a trade or not. I'm constantly referring back to static price points that are salient to me. That's that PD array matrix. I'm looking at price through the lens of a grid. Where are we at in that grid? Are we in the upper boundary of it in the last 5 days? Or are we in the lower boundary of it? How did we spend time in the discount side of it or the premium side of it? How's that work towards my current narrative and bias for the price action? If I'm bearish, do I really want to load up on new shorts while we have been staying in the lower half of that PDRA matrix and there's a big red folder event later in the day? No way. Why? Because they can use that red folder event to create a Judas scenario where the market may rip against the underlying real market move that may transpire. But they know that the public will see these big runs. They're eventful. They're like watching a train wreck or a car accident. You really don't want to see people get hurt. You don't. And not if you're sane. But it's real hard for you not to look at it. You're stuck in the traffic. Nobody wants to go because you're rubbernecking. But you might as well just take a look and see what they're looking at too, right? And then you can't look away. Well, that same phenomenon takes place with these big market events. And what happens is it causes you to forget what you were looking for. No one's paying attention to the lines on the street or the obstacles that may be in your pathway driving because you're looking at the car wreck in the other lane. Same thing's happening here. Distraction is a wonderful agent of chaos, and market making utilizes that a lot. And the primary driver for that is the economic calendar. So having a expectation of where you think the market's going to go helps you balance and manage what you think may happen as a trap or a snare for less informed traders. So anyway, I could keep going on like it's X space or a Twitter space, but I said enough. I want to get in here and kind of give you some technical stuff. All right, so let me look at my time real quick. All right, we'll close the stream at 9:10. Okay, 9:10, and then we'll go over to X, and anything that's salient I'll call out from over there. But if you look at the 1 minute chart here, this red box up here, remember what that was on the daily chart? It's that volume imbalance. So let's go back out to a daily chart real quick. Okay. So there's our key levels for today. We already pierced yesterday or previous day's low there. And here's that volume imbalance. All right. So back down into a 1 minute chart. This is just the fair value gap on the 1 minute chart. The daily volume imbalance is up there. Okay. So now let's go over to last night in the London session. High frequency trading, sub 1 minute. Okay, this is the kind of like the topic here. And I'll show you that I can teach in very small little segments. Okay, but I want you to understand you're not going to learn everything when I teach it this way. You're going to have just a bullet point view. And what you're going to do is you're going to go in there and using what I'm going to say today, and you're going to have hundreds of new questions, which is why I say a lot of things about what I teach at the time, because I know what the questions are going to come by watching whatever it is when it's condensed format. So short form teaching has its place, but if you really want to learn, you don't want short form education. You want long form education. That means give me all the details. Get in there and tell me everything subtle, every subtle nuance that you're willing to share. I want to hear that. So now let's go through and look at time. Here's 2 o'clock in the morning, 2 o'clock Eastern time. Always have your chart set to New York time. Okay. So it's 2 o'clock in the morning to 5 a.m. ICT New York, London Open Kill Zone. That's what that is. In this setup, you're going to see using a higher time frame premise, which is this pink box, which is what? It's the daily volume imbalance. I'm going to maximize this chart because I know you're looking over here and this is taking your attention. How'd you catch me doing that? I've raised kids, man. I know what you're doing. So here is that area shown through the lens of the ICT London Open Kill Zone. So the market travels outside of it. It does so here, creates a run there, and then drops down into this inefficiency. This right here could be used for a model 2022. You could be entered into that and you could have been stopped out and you could take a loss. And let's just for the sake of conversation, let's just say that's what took place. Okay. I want to be practical. I want to be able to tell you things that you're going to encounter and how to work with it. Okay. So let's assume that you took this trade and you got stopped out with a stop loss rate above this high, or maybe you gave it some extra room and you used that high and you got stopped out right there. No problem. No problem at all. If you were trading with one micro like I've told you to do and you're in demo, you're not going to lose any sleep over that. So the market creates another run higher than that. Are we bullish based on what we just saw happen in NASDAQ in the last 2 days? You shouldn't be because it went up to a pool of liquidity, tapped it, and then failed to hold that level after NVIDIA earnings. NVIDIA many times will push the market from a fundamental reason, but if that's the fundamental reason, What is it really doing? It's propping up the market so that way retail traders that see that say, "Oh, wow, this one stock's gonna make all the entire stock market go up for the next couple weeks." That's fallacy. That's a fallacy. It means it's a myth, okay? So I have to manage my time here. We have a hypothetical stop out on this run here. If this is in fact the high of the day or a turtle soup, the market needs to not only displace lower, but it needs to get into a level from a higher time frame perspective, which is that volume imbalance on the daily chart that's showed here in red. Here, we see it dive down in. There's a small little gap. You see that? Let me widen it out a little bit. There you go. You should be able to see that a little bit better right here. So this inefficiency, because this SIBI right here is not butt up against this wick. Now, if this SIBI was this immediate candle to the right of this wick, we wouldn't be using the fair value gap. We would just be measuring the wick. Big, listen to me, mentors. Okay. You're out there teaching my stuff, thinking you know something. This wick right here, if this was exactly to the immediate left of the SIBI, but see, we have the SIBI formed here where there's one candlestick barrier to that wick. If this SIBI existed right up against this as the immediate next candle to the right of that one, we would not use that fair value gap at all. We would just simply use the gradient levels on the wick. Just say, I'm just tossing in there, no extra charge. Go back and look at old price data and you'll see the benefit of knowing what I just told you. This SIBI, because we don't have the wick to the immediate left, this is a valid premium PD array. So it would be viewed like this. And let's just make it a little bit darker. Okay. And then, so right away you can see we used the top of the volume imbalance. We traded back into the gap and it went a one tick above, just coloring outside the lines of that volume imbalance on the daily chart. If you were shorting this, any short entry in here, the stop needs to go right above this candlestick's high. By the way, I helped Cameron with the stop loss the other day in that trade you saw. I was just putting my little fingerprint on it. He can't manage his stop losses like that. That was me teaching, but he's pushing the buttons otherwise. The idea of you're a liar, ICT. So what am I? I'm a lying fraud because I don't make money, or I'm a lying fraud because I'm making lots of money in my son's account. Isn't that funny how that works? Diabolical. So anyway, this is where your stop loss would be, and your entry would be anywhere in here. Now, which price level would you use? You personally. Well, think about the logic. Okay, we're talking about high probability entries, but now we're going to incorporate lower time frames, sub 1 minute. So now we can go into this little range right here. The stop has to be defined right there on that high. Why? Because of the volatility. Now, because of the volatility being so extrapolated and large, we have to consider the formation of the setup time frame for our stop loss. Whereas if we didn't have this wild volatility, then we can go into sub 1 minute in this fair value gap that's shaded here, that's darker. We could use that, and the stop loss could be framed on this swing high in here. And I'll show you what I mean. Let's drop down into, let's go to a 30-second real quick. All right. And that's the business there. You already noticed on the 1 minute chart that the bodies were already staying in the lower half of that fair value gap. So what you want to see is how the market trades into the upper half. You give it a chance to do so. You might miss the trade. It might happen where it goes up there so quick and then starts running away. Well, you missed it. But because you're in the lower time frame setups, there's so many of these forming. We'll go to 9:15, by the way, because I'm not going to be able to talk everything in the time I needed. So You want to try to enter in the lower half. That's your high frequency trading window of entry. The barrier of entry is you need to be inside of this portion of the move. And I know some of you don't like the idea of that. You want to get up here in the upper half. Sure, I do it sometimes, but my experience is a little bit larger and longer than yours. So, how do you get in the move and know that you're going to be a part of it and not be afraid that you're going to miss the move? So, you want consistency, continuity, but you're also not going to over leverage and over trade. That means use the smallest amount of leverage, one micro. You're not looking to make millions of dollars on one trade. You don't care if you get stopped out. In fact, we're going under the premise that you got stopped out overnight in the London session. Now you're using it again. Notice that we're using the high of the volume imbalance on the daily chart because it's a higher time frame PD array. It trades to the high of it. And does it hold that candlestick? Because it opened here and went all the way up here. At one point, there was a big green candle like that. And then it does this, it comes down here and closes. Where does it close? Below consequent encroachment. That's this level right here. So now the immediate next candle, anywhere, anywhere below that midpoint, that consequent encroachment, anywhere in there, but above the low of the candlestick's high, which is the framework of the low of this gap framed on a 1 minute chart. You can enter here. If we were not seeing elevated volatility, you could place the stop loss one tick above this high. But because, listen, folks, listen, man, because the volatility is so extreme, because the likelihood of the ranges sharing the previous candle's range, you have to go outside of the immediate smaller time frame price range, which is what we're identifying here. So you got to go back to that 1 minute chart and use the high I showed you. You can't you can't try to trade with these super tight stop losses and not expect to get stopped out a lot. You're going to get stopped out a lot. And commission costs add up. Losses, even though they're small, they will add up. And the frustration, the compounding frustration of you taking small paper cuts, they still hurt, don't they? As soon as you put your hands in something that has alcohol, or if you put your fingers in something that has like a citrus juice, like an orange or a lemon, and you have a paper cut, you'll find it. Eat crabs and get a little slice in your finger. You'll know all the little wounds because it's painful. It gets in there and irritates it. So it's hard to focus and concentrate, taking and trading new risk when you have these compounding effects of pain. So you want to enter in the lower half, use the higher time frame where the setup formed, use that for your stop loss. That means, yes, you're probably going to trade with less contracts. And that's a good thing right now. You're not trying to make a lot of money in a very difficult market condition. So many of you want to come out here, and I'm going to tell you what it is, okay? So many of you want to come out here just so you can say to an old guy like me, say, don't listen to ICT because he says don't trade on Mondays. And look what I did. I made this. Motherfucker, show me your entire show. Don't just tell me after you did something. Tell me what you're going to do beforehand. Tell me the level you're going to trade to. Do all that stuff. Okay. Everybody wants clout. They want to come out here and say, this guy or that guy says, don't do this and don't do that. How about stay in your lane, make your money, hang out with your friends online, and stop being an asshole? How's that? How's that work for you as a suggestion? And stop charging money. Oh, but that ain't going to happen now, is it? So everybody wants to be a hero. Everybody wants to be a smartass. Everybody wants to reinvent the wheel. They want to coin something. They want to prove a logic is no longer valid. They want to prove there is no algorithm or there is a change in the algorithm. And everybody else is wrong. Okay? Trust me when I tell you that. That's the one thing you can know for certain that I'm right about. Everyone else but me is wrong. Okay? There you go. Nice fuel for the weekend for that. Social medias. So the market uses this area for entry, and the immediate run would be here. So now I know some of you are thinking, that's not enough, ICT. It's enough when you're working with ample size of an account. You've been doing it for a long period of time. And this right here will tell you whether or not you can make money on the trade. Can you make money with this run here? That low is 68. You're entering in around 78. That's 10 handles. Can you take that target there and say, I'm comfortable with it? Some of you might. There's a lot of people on the internet that just simply look for 10 handles. Trades by Matt does it all the time, and he's taking payouts. So I'm not going to knock 10 handles. I'm not going to say that that's a bad thing. Me personally, I would like to see a minimum of 15 handles. So as luck would have it, you have something over here. So now we're closer to that 15 handle run. So getting short up here, aiming for that pool of liquidity right there as a first primary scaling opportunity to take a partial. That would be viewed like this. There's sell side. Entering on a premium. Premium to what? That sell side liquidity pool. And then we have that low. Now, this low is more likely to be a factor because what? What's this dotted line here? That's consequent encroachment of that volume imbalance on the daily chart while being bearish because it rejected the recent highs on the daily chart after NVIDIA earnings. So, consequent encroachment is always a draw. Always a draw. It's always a draw. And if we're up here, first partial, doesn't mean you have to take it, but it means that once we get below it, then we want to see displacement. If you're not going to take a partial and you're only trading with one contract, wait for displacement. What does that look like? That. We could create a short-term low, then it dives lower, closes, the next candle starts to run lower. You can see that is displacement. So now you can, instead of taking a partial here, you have one contract, roll your stop loss from where it started over here down to just above that high. So what I just taught you was how if you're only using one contract and you can't take a partial because if you take a partial, you're closing the only existing position size you have. So you wait for a key low, which is what I just mapped out here. Not this one, because I want at least 15 handles or I won't take the trade. Once it takes that low out where a partial would be taken, that displacement affords me the opportunity to then move my stop loss just above that high. What high? This candlestick, because this is the displacement candle. And then as it moves lower and lower and lower, we want to see it gravitate to consequent encroachment, which is that big red area from the daily chart. That's that volume imbalance. That's the draw. When it does that, okay, we anticipate it not just trading here, but there's liquidity resting below that. So now we can do this. That's the sell side liquidity pool that you could take a partial or a full closure or wait for it to use that level and displace away from it. Where is that? There. It trades above it here a little bit. Your stop loss, if you were trailing it and you only had one contract, would be here. You're not in jeopardy. You're anticipating this. The market rolls through. Once it leaves this key level on the downside again, you're looking for displacement. Is this displacement? No, it's not displacement because it created this low right there. That low needs to be pierced to the downside. Does it do so? Yes. Does it do so and leave it as a SIBI? Yes, it does. So when it does this, then you can move your stop loss from here down to this candlestick's high because that's the leg that starts the price run lower. This run is sell side delivery, not sell side liquidity. It's the running lower of price action. So that means you put your stop loss right here. So now what you have done is you've captured very close proximity to that low where you would have closed your trade for full target. Remember, you're on a very small time frame and you're using a micro structure approach to trading these price legs. Once this does this, you've afforded getting stopped out, holding the position in case it gives you a little bit more room to run to where? The low of the volume imbalance. Why? Because we're bearish. This little gap in here gets traded up into here and then runs to the low. That would be your next objective. So you can close it there and anticipate some measure of retracement. Why? Because this is a higher time frame daily volume imbalance. It may come back up to consequent encroachment of it. But if we're bearish, we want to see it not do so. Here's where it trades up to here and then rolls over and goes lower. But I wouldn't have caught that. Stop being fucking greedy. So, Michael, please stop cussing. Don't come to my live streams because it's probably going to come out. We're talking about trading. Okay. It's going to come out sometimes. So if you are looking for a larger price run, you can see anticipate it retracing back to consequent encouragement. But then if it displaces outside of and below this low, because the displacement has to go before below a key low or above a key high. Is this displacement here? Yes. The market trades back up to the low of the volume imbalance on the daily chart, that big red box, and then it moves lower. Once it displaces below that low here and it closes, you can move the stop loss from here down to that candlestick's high. I'm teaching stop loss management. Can you teach stop loss management ICT? Sure. Here you go. And the market trades lower and eventually dives even lower and moves into those targets I gave you this morning where it was gravitating towards an old smooth little area. Okay, we're getting close proximity of those same time frames. Now, I wasn't on the chart at 5 o'clock in the morning with you all, but you can see how that would be useful here. And once we had displacement below this low leg, that you could trail your stop loss from there down to that candlestick's high, and then you're strangling the position because it's already moved so far outside of the level you anticipated as just a reasonable target. So that's high frequency trading on a lower time frame, stop loss management, and hopefully you learned a little bit there. Don't worry, it's not the only time I'll talk about it. There's other things I want to teach in regards to it, but that's it for this one. Hope you found it insightful and have a pleasant weekend. Until talk to you next time. Be safe.